All right, bit of a rebound yesterday, but not a heck of a lot of movement today. Up about 1/3 of 1% in futures. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, a big win for the banks. U.S. regulators scale back capital requirements for Wall Street firms from 19% to 9%.
Meanwhile, big tech suffers a dual setback. Apple and Google lose in separate multi-billion-dollar court fights at the EU.
Plus, Philly face-off. Harris and Trump gear up for their first and maybe only debate. We're live on the ground with the latest. All that and more coming up, but 30 minutes ago until the bells ring. Let's take a look at these markets. As Matt said, not a ton of movement, but still green on the screen after that big rebound we saw yesterday. Of course, the S&P 500's first gain yesterday after 4 straight days of losses. Currently up about 0.3% pre-market. Same thing, too, if you take a look at big tech. Currently up about, I'll round that up to 0.4%. And meanwhile, flat once again in the bond market, but the levels are getting lower on the 10-year yield. Matt, we are below 370.
Yeah, last week was the worst start to a month in data going back to 1953. That's before even I was born. The reason is the labor market, and you can see here in white the NFIB's labor picture. It kind of front runs the actual unemployment numbers, and it's on its way down. So what does that say about jobs in America?
Want to look at some pre-market movers as well because we have some things moving. Oracle climbing after an earnings beat as AI demand boosts its cloud computing business, hitting it up against the likes of Amazon, Microsoft, and Google. You have Oracle now up more than 8.7% pre-market, but Apple and Alphabet really feeling some softness. Apple really down about 0.8% here, and Google, they both lost those EU court battles, you may remember. Google was fined more than $2 billion for allegedly abusing its market power. Alphabet now still up about 0.8%. Apple had lost its fight over a $14 billion tax bill with Ireland. And watching Goldman Sachs because the trading unit is on track to drop 10% from the prior year, and that's led by declines in the fixed income business. According to CEO David Sullivan, Goldman shares now down about 0.5% pre-market, Matt.
Yeah, actually a ton of bank news out this morning. As you pointed out at the top, Sonali, our scoop on capital requirements. They're only going to be an increase of 9% for the biggest banks. We were looking at 19%. Either number seems huge to me if these banks are really, fortresses of security.
That's true, but still 9 is lower than 19. And as such, you take a look at JP Morgan, Wells Fargo, Bank of America today. They're all climbing pre-market. Of course, we're going to hear from Michael Barr at 10 a.m. today, so I'm expecting more headlines there.
It's certainly fireworks for the financial industry, and I've got to say, I know you and I have a different way of looking at this, but you think about what Steve Eisman said, to say that kindly, but Steve Eisman had said the banks would be a trade going into the U.S. election, and indeed, you have these capital requirements going in much softer while we're still in the center of the Biden administration. Let's see how the story goes.
Yeah, absolutely. Let's bring in Bill Smead, actually, to talk about it. Smead Capital CIO. Financials are one of his top allocations. Bill, great to have you on the program. Really serendipity today because of all this news coming in on financials. First of all, the capital requirements. I mean, it strikes me that raising them by 9% is a little much if these are very safe banks. Do you think it's necessary?
Well, the curse of regulation was a blessing 10 years ago, 12 years ago. In other words, we were talking before we went on air about Occupy Wall Street. The pressure coming out of the financial crisis was immense, and the discipline created by the regulatory environment laid the groundwork to make the moat bigger for the Bank Americas and the JP Morgans. So any kind of regulatory difficulty has a tendency to work in favor of the biggest players.
Are you expecting that to be the case this time around? I mean, reading this, of course, Bloomberg News Scoop, are you saying this is an opportunity, I'm going to add more?
Well, no, because we've held Bank of America and JP Morgan since 2012, and so they've succeeded. The stocks have done very well, so they're a large position in our portfolio. We run a concentrated portfolio of 25 to 30 stocks, so that means an average of about 4%. So we're not adding to them. What we're more worried about is the stock market environment in general, we think we're in the fourth major peak in the last 100 years. And the banks are more intertwined with the investment business, certainly the money center banks are, than they ever have been before. And it's been wildly profitable. And therefore, the thing that's different this time is if the investment environment turns lousy for 4 or 5 years, the profitability of the investment side is going to go way down. And that would be the thing that would make us nervous.
Well, do you see that happening? It's interesting because another company you watch very closely is, of course, Berkshire Hathaway. You see them trimming that Bank of America stake in particular, one that you've held as well. You see them trimming other things as well. Is it time to be trimming?
Well, it's so funny you mentioned Buffett, and I mentioned there's been 4 major peaks. The major peaks were 29, 69, 99, and now. We know what Buffett did in 69. He closed his partnership and sent 85% of the money out to the partners and had them keep the Berkshire Hathaway shares. So he literally was as bearish as you could possibly be at the beginning of 69. At the same time that T. Rowe Price got very bearish, the most successful growth guy up to that point in time, and he formed the New Era Fund at that time. So then go up to 99, and Buffett went to the Allen and Company conference in the summer of 99 and told all the dot-com billionaires that the stock market, from 64 to 81, the economy grew 4.3%, and the Dow, which was the primary benchmark in those days, by the way, when I started the business 44 years ago, was the primary benchmark, had gone nowhere, even though the economy was growing at 4% a year.
That answers some of your questions about can GDP be growing in the stock market? Why wouldn't it grow with it?
But I mean, my big question, though, going back to what you said about the trading environment and how intertwined these money center banks have become with the markets is, yesterday we have a pretty obvious question then, because David Solomon came out at the Barclays conference and said the trading unit is dropping 10% year over year. I mean, have we seen the peak of the market profitability for these banks?
Well, that brings us to the other part of the subject, which is, it's very fun, and thanks for the question. If you sat down 10 or 12 years ago and you said, I'm going to buy the 10 things that did the best last year at the beginning of every year, you'd have done really well. And that's happened never. It's never happened before. I'm 44 years in the business, and that's not a good strategy. So you got to expect that to break at some point. So the problem is this has been a momentum market created by 1% interest rates for 3 or 4 years, and the reverberation of how inflated people's confidence in investing in common stocks associated with affected by those interest rates is it's going to be a rolling thing. So first they took Beyond Meat and Peloton out and shot them in 2022, right? Yeah. That bear market was all about the high price to sales ratio, IPO, SPAC, the crypto, and all that kind of stuff. Okay, so you went from FANG plus high price to sales insanity, and then that died and it morphed into the Magnificent Seven, the next game. But Munger, Charlie Munger, and I was here with you folks the day that Charlie passed, and Munger said, they showed the quip from 99 at the Berkshire Hathaway annual meeting. He said, look, when you have a financial euphoria episode, it's like a Ponzi scheme or a chain letter. And if you put a legitimate development into it, it's like mixing raisins with turds, he says, and you end up with turds. So think about it. The legitimate development, 29, was radio, the landing on the moon in 69, the internet will change our life, and now artificial intelligence.
Well, talk to us about that, of course, because I'm looking at your notes. You say quality and momentum, those factors are going to get crushed. Of course, you referenced Peloton. Peloton still can't get off the ground. But you think about companies such as NVIDIA. I mean, that's a business that's been around for 30 years. So this kind of momentum that they're seeing, the enthusiasm behind them, do you think that they'll be able to escape that bubble bursting?
Well, within NVIDIA, the subject is it a legitimate development? And the answer is yes. So let's just use Cisco as the poster child for the legitimate development. You could have got very excited 98, 99 about Cisco, and I did. I had a buddy in the brokerage office that I was in at that time who was all over Cisco like a blanket in the late 90s and made a ton of money for people for quite a while. Cisco was the only one that had the router, and the router was the main core tool to make the internet that changes our life work. And the stock exploded, and on March 27th, 2000, reported earnings and became a $600 billion market cap company at that point in time. It is 15 times larger corporation than it was then, today.
Right.
And it's never seen that price. It has not seen that price since that day.
But Bill, so you're comparing now to 1999, and it makes perfect sense to me, but what has to happen to burst this bubble, or when will it burst?
So you have to go back to John Kenneth Galbraith's A Short History of Financial Euphoria, which was last updated in 1990, and you think he wrote it last week, although he's passed a long time ago. And the answer is manias die of their own weight. You just don't know. There's no way of knowing. So Buffett likes to explain it like it's Cinderella at the ball. She knows when the clock strikes midnight that it's all going to turn to pumpkins and mice, but there's no clock on the wall. There's never a clock on the wall.
Right.
So you don't get to know.
So we don't know if it's 7 p.m. or if it's 11:55.
Exactly. You never get to know. But what you know is the torture chamber that follows is vicious. Right? It's incredibly vicious.
Right.
And to answer one of the questions you were bringing up a minute ago, when the economy's strong, Main Street absorbs capital and it drives up interest rates and inflation. When the economy's lousy, the Fed creates money and it all slops into the security markets. So that's why the stock market does well when interest rates are going down and the Fed is friendly. But we have very favorable demographics. We're actually very positive about the economy, and that's one of the reasons why we like the oil and gas business.
Bill, we have to get you back soon. Somehow we're up against the clock here, but next time, come back. We're going to talk about energy and gas and what's going on in that industry. That, of course, is Bill Smead. He is Smead Capital CIO. Meanwhile, let's get a check on these futures right now. The S&P 500 moving higher pre-market, camped out about 0.3% higher, slightly more so if you take a look at big tech. Small caps not exactly joining in on the action yet. The Russell 2000 currently flat on the day. But let's take a peek under the hood. We're going to do that with Abigail Doolittle.
Well, we do have some news right now, breaking news, in fact, Katie, on Apple. Apple sees a one-time income tax charge in the fourth quarter of up to about $10 billion again in the fourth quarter. And I believe that this is related to the loss that they suffered along with Alphabet, related to a overall $14.4 billion tax charge in the Irish tax case. The stock right now down about 0.75%. And of course, yesterday was the release of the iPhone 16 and the iWatch, or the watch with the bigger screen. Investors not so wowed by it. Let's take a look at the shares of Stellantis. These are also lower, down by about 3.2%. There are some reports of fires with Jeeps, but I think something weighing here more may be BMW margins. They did cut the forecast. And then finally, of course, the big debate tonight between VP Harris and former President Donald Trump. On this, we do have Trump media up about 1.8%. Yesterday, up about 5.5%. But it's worth noting into today a big slide right around the area, the price where it went started trading on the NASDAQ, Matt, earlier this year.
Thanks very much, Abigail. Do a little taking a look at some of the stocks that we're watching ahead of the open. Coming up, it is debate day, so we'll look ahead to tonight's showdown with Tobin Marcus, head of policy and politics at Wolfe Research. This is the big event, folks. This is Bloomberg. Let's get now to high interest to look at what's making headlines around the world. Earlier this morning, SpaceX launched a rocket carrying 4 private astronauts to space as part of a groundbreaking mission to perform the world's first commercial spacewalk. Among the crew is billionaire Jarek Isaacman, who previously flew to orbit with SpaceX in 2021 and provided funding for the flight and its development. The spacewalk is set to occur on the 3rd day of the flight. The mission should last roughly 5 days before the crew returns to Earth. BMW cut its outlook for the year over a faulty braking system from Continental that prompted recalls and delivery stops affecting 1.5 million vehicles. The German car maker now sees earnings significantly lower than a year ago. Both companies, BMW and Continental, said the vehicles are still safe to drive. And speaking of cars, Aston Martin has signed star designer Adrian Newey in a bid to thrust its Formula One team into championship contention. Newey will take on the role of managing technical partner after having helped Red Bull Racing win several world titles. The BBC reported his contract to be worth as much as $39 million a year. Katie.
All right, let's transition into politics here because we're just 8 weeks away from the U.S. presidential election, and former President Trump and Vice President Harris gearing up for their first debate in Philadelphia tonight. And the stakes are high. Let's unpack why now with Tobin Marcus. He is head of policy and politics over at Wolfe Research, joining us at the desk. Great to see you in person.
Likewise.
So looking ahead to tonight, what does Trump need to do? What does Harris need to do? And how are those two missions different?
So I think the big fight tonight is going to be over who represents the riskier choice for the American people. So Trump is going to be out there characterizing Harris as far left, characterizing her as extreme, trying to keep her from running away from her history of, much more liberal policy positions in the 2020 Democratic primary, as well as the unpopular elements of Biden's record. Harris, I think, is viewed fairly favorably. There are a lot of people who want to hear more about her. That's one of the things we see in the polling. There is some curiosity, but she needs to start filling in those gaps. I think the strategy of hiding from the media has gotten a little bit too cute. She's run as far as she can, probably on vibes alone. So, I think her agenda is something that appeals to voters. She's laying out a very moderate agenda that, if voters believe it, is something that's going to resonate. But she needs to explain that to them. A lot of people haven't heard about it, and she needs to do it in a way that they believe is authentic. They feel like they actually understand what she stands for, and then contrast that with Trump.
How much substance do you think you'll actually get out of tonight's debate? Because there's a real scenario that this becomes a whole lot of bickering.
Yeah, so I think that the muted mics that they managed to agree to with Trump's team polling for that after Biden agreed to it way back when should prevent it from devolving into the worst form of food fight, like the first Biden-Trump debate in 2020, where voters literally could not understand what it was that they were hearing. I think it'll be substantive in the sense that both of these candidates have their goals run through policy. Harris needs to, again, explain her agenda, why voters should believe that she'll actually govern as a pragmatic moderate. Trump needs to tie her to a history of past, progressive policy positions. So they'll be talking about policy. In terms of what investors are likely to get out of it, I don't think that we're going to get a ton of incremental clarity about the details of Harris's policies or what's likely to get through Congress. Since if she wins, she's very likely going to have a Republican Senate that she's facing. The sort of whole expansive agenda she's laying out is not going to get done. And the question of what gets prioritized, what can she get consensus around, those are not things that we're going to learn anything about in the debate.
I always listen to Balance of Power with Joe Matthew and Kayleigh Lyons. I think it's one of the best shows on this network. And yesterday they had Mick Mulvaney on, obviously an insider, used to work for Donald Trump. They played an ad from the Harris campaign, which had a number of people who used to work for Trump, including the vice president, Mike Pence, say they were not going to vote for the former president this time. Listen to what Mick Mulvaney had to say.
Jim Mattis, John Kelly really, really don't like the president. I get that. What I can't get, Kayleigh, is this whole, Dick Cheney, Liz Cheney saying they're going to actually vote for Joe Biden. That makes me wonder if they were really Republican in the first place. I could see Republicans who say, you know what, I can't bring myself to vote for Trump. But to vote for the most progressive left-wing candidate this country's ever seen before, that tells me a lot about more about the Cheneys than it does about Donald Trump.
It's Kamala Harris running and not Joe Biden, but it doesn't really matter. His point is she's so far to the left that, he can't believe any Republican would vote for her. Is she really that far to the left?
So I look at her as a pragmatic. I think that she took a bunch of opportunistic far-left positions in 2019 based on a read of where the primary electorate was. She's now making an opportunistic shift to the center. I don't know that she's really genuinely that much more committed to one of those agendas than the other. But, in terms of the Cheney's consideration, again, she's going to be checked by Congress in all likelihood next year. So, for my mind, if you look at Trump the way that they look at Trump, it's a pretty reasonable choice because you're not actually endorsing some massive leftward swing in policy. You are, I think, probably putting bipartisan government in there while preventing Trump, who they are characterizing as a grave threat, from getting back in.
And Tobin, a fact that I keep coming back to is that tonight will be the first time that Donald Trump and Kamala Harris have met in person that we know of. That's just amazing to me. And I think it speaks to just how compressed and strange this campaign cycle has been, which probably, again, raises the stakes on tonight's appearance.
Yeah, absolutely. I agree. It's totally wild that they've not run into each other. D.C. is a pretty small town, but obviously not that small. Look, I mean, I think we've never seen a contrast of their performance styles next to each other. One of the other big things that I think she needs to accomplish is just looking presidential. This will be the first time that she's stood next to him. It's certainly the first time voters have gotten a chance to see her standing next to him. And so showing, can she go toe to him? Can she, come across as tough and cool and collected and in command of the issues? I think those things will matter for her, and that she does have a bar to clear and some potential upside if she clears that bar. Even if she can't sort of fully satisfy people that she's genuinely going to be a moderate, just showing that, making it possible that voters can picture her as president is half the battle.
Tobin, we thank you so very much for your time. That is Tobin Marcus of Wolfe Research ahead of a hotly anticipated debate. Bloomberg Television and Radio will have special coverage of ABC's presidential debate between Harris and Trump tonight, starting at 8 p.m. Eastern. This is Bloomberg.
All right, it's time now for Social Climbers, the companies making waves this morning. And first up, Mission Produce is rocking the guac. The avocado producer reporting third quarter revenue that topped estimates thanks to increased demand for the fruit. Next up, Under Armour is lowering its outlook for the year. The athletic wear brand said that its restructuring plan will cost more than predicted. Remember, the company is reorganizing itself under CEO and founder Kevin Plank, who retook that top role in April with the promise of finding cost savings. And finally, consumers getting some relief from grocery bills, especially if they shop online. New data out from Adobe shows that online grocery prices fell over 3.5% last month, which is the largest decline since that firm began tracking the numbers 10 years ago. Of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Meanwhile, we're about 4 minutes away from the opening bells. You can see right now the S&P 500 currently up about 0.4%, building its momentum in the pre-market. The NASDAQ 100 a little bit ahead. You can see big tech regaining some of its momentum that maybe it lost last week. And the Russell 2000, guys, the small caps, also up a little bit, about 0.1%.
I hadn't realized just how bad last week was. I saw in the Bloomberg market moving story
miserable.
The worst start to a month since 1953 at least.
Yeah. You're having some of that bad attitude get wiped out of the market right now. Oracle helps actually too. You're seeing the AI trade back in play. Let's see how long it lasts.
That's true, of course, and this is going to script. We knew that September was going to be bad, but I think last week still surprised a lot of people.
Yeah, absolutely. Well, when you have a company like NVIDIA that goes from 600 billion to 3 trillion in such a short time. All right, we're going to come back and talk to Franklin Templeton's Katrina Dudley. This is Bloomberg. Futures continue to trade positive, just 20 seconds away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We had a good day yesterday, up 1.2%, and we're seeing continuation of that, not to the same extent, but S&P futures as well as NASDAQ 100 futures gaining about 1/3% today ahead of the big presidential debate. I think political risk is front and center. Obviously, you had the growth scare that caused us last week to have the worst start to any month since data going back to 1953. So in at least 70 years. To me, that's pretty significant. Here you see Black in Business, Goldman Sachs, 1 million black women ringing the bell at the New York Stock Exchange. Down at the NASDAQ market site, you have T. Rowe Price ringing the bell with, it looks like, an ETF. And ETFs are a hot topic at this hour. We're going to bring you some news on ETFs and private equity in just a moment. But right now, let's get a check on the major averages. For that, we go over to Katie Greifeld. Katie?
Yeah, 37 seconds into the trading day. You can see, again, we have green on our hands following what we saw yesterday. Of course, that big rally that Matt was referencing remains to be seen whether last week, of course, was a seasonal blip to be expected, or maybe if we see this rally go south. But for at least right now, the S&P 500 up about 0.4%. The NASDAQ 100, your big tech stocks, up by 0.5%, and small caps also seeing a little bit of love. The Russell 2000 up about 0.2%. Now, underneath the hood, some stocks to keep an eye on. We had Oracle and Rubrik reporting after the bell last night. You have Oracle touching an all-time high right now as demand for AI cloud infrastructure continues to outpace supply. A different story, of course, for cyber firm Rubrik, which also reported earnings, signaling doubts about growth in the second half of the year. And you can see that in shares right now, Sonali, down about 4%.
Fascinating. Not the first time we've seen that in the cyber industry during this earnings season. We're going to take a look also now at HPE. Hewlett-Packard Enterprise is falling after announcing a $1.3 billion mandatory convertible preferred stock sale to help fund its acquisition of Juniper Networks. You have HPE down 8.3% at the market open, Matt.
And the EU's Court of Justice in Luxembourg siding against Apple and against Google in a couple of multi-billion-dollar cases regarding the tech giant's business practices. Here's what EU Competition Commissioner Margaret Vestager had to say about the developments.
You need to, of course, own your victories, but you also own your defeats. And we've had both. And hopefully that shows that we're willing to push the envelopes, also sometimes to take a risk in order to try to make sure that the market serves the consumer and that we are not just small pawns or meat for the machine.
Bloomberg technology co-host Ed Ludlow has the details. And Ed, I'm not sure if it's a huge surprise, at least in the case of Apple. We knew they were moving events ahead, right? Moving events up in order to avoid some kind of news like this. What's your take?
Well, I mean, Apple's response is that they're disappointed, but I think you're probably right that the market's braced for this, particularly if you look at where the stock's trading in the first few minutes of the session. I mean, it's down 0.8%, right? Vestager, this is a big win for her. You know, she's maintained this argument in Europe that any member state making a selective tax deal with a specific company is illegal under state rules, that it basically accounts or equates to state aid. And this goes back to 2016. You'll remember Tim Cook famously said that the original order for Apple to pay back taxes in Ireland was, quote, total crap. And
second reference.
Here we are. It's happened.
And I didn't know you were allowed to say that on TV, so it's very exciting to learn that. Let's talk a little bit more about Apple specifically, though, because, of course, this comes after their big day yesterday. And if I recall correctly, one of the reasons they had that event on Monday was because we were expecting this ruling.
Yeah, that, and also we have a presidential debate tonight.
I heard about that,
you know,
yeah.
The Bloomberg reporting was that the Apple Glow Time event had been scheduled for the 10th, and ultimately it was the 9th, and yesterday it was important. And, you know, it's hard to know with the stock down 1% whether we're trading on the hardware and Apple Intelligence announcements of yesterday, or if this is the Apple Ireland tax ruling. But generally the summary was less than substantive hardware updates, modest hardware updates, but kind of more visibility on the path forward for AI for Apple. And there was a lot to like in that respect.
Does it matter at the end of the day whether it's about the EU here or about kind of the muted response to yesterday's event? At the end of the day, what's going to create new momentum in this stock?
Yeah, I guess the idea that Apple, if you separate it out from the Mag 7, has traded much more in line with the S&P 500. And for all of this speculation in markets about valuation, growth, there was potentially more upside in this stock. The hope was we probably got more yesterday. You know, the sequence of events is we now know what the new iPhones look like, and they'll ship it in the 20th of this month. But the rollout of Apple Intelligence, the AI platform, which the stock has traded in most correlation to, is kind of staggered. You know, the first update with limited functionality will be next month at some point, then a little bit more at the end of the year, then the key features next year. But the bulls on the street and market researchers for smartphones would say there's likely evidence that the consumer around the world still upgrades their handset purely out of anticipation.
Ed, we thank you so much for your reporting. Of course, just an incredible 24 hours. That is Ed Ludlow in San Francisco. We're going to now bring in Franklin Templeton Public Markets Senior Investment Strategist Katrina Dudley, because there's a lot going on this week between what we saw with Apple yesterday to the debate tonight to the CPI tomorrow. What do you think ultimately is going to be the new narrative for this market headed into the end of this year?
I think the election is going to be the front and center. So first of all, we have the presidential debate that's happening this evening. And in terms of expectations, this is really the first time that we get to hear from Kamala Harris as to what her policies are. How aligned are they with the Biden policies and how differentiated they are? And so I think that we're going to get a lot of news from that perspective. And I think that's helpful for markets because once we know policies, we can frame policies and can we accept their impact. You then follow it with October 1st. We have another vice presidential debate, and then we go into the election season. And we've done the research. I think that going into elections, it's the heightened volatility that causes the issue. It's actually not as much the policy as the fact that there's uncertainty. And with such a tight race, we do think that the uncertainty is going to be high.
And we have reporting that shows hedge funds are freeing up cash to be able to trade around November 5th. Is that something that's typical, or is this election different than others?
You're asking if it's typical for a hedge fund to have trading activity?
No. I mean that investors, that markets really want to trade around elections this much because this time, I don't know if it's just because it's now, feels quite different.
I'm in the camp I would wait for the end of tonight before I started freeing up that capital because you want to see how different the policies are. Because if the policies are the same, going into the election isn't going to matter if it's the same type of corporate tax cuts and everything. But if one is saying I'm going to cut corporate taxes and someone else is saying I'm giving incentives for green investment, you've got different ways to play it, and that's where that trading capital will be very important.
That's interesting. So basically you're saying you want to see how big the overlap is in the Venn diagram.
Absolutely.
Yeah, okay, so...
We love a Venn diagram.
I know, Kamala Harris in particular likes Venn diagrams. So we have the debate tonight, then we have CPI tomorrow morning, which is very exciting. This is an impossible question, but which one is more important?
The debate. Yeah. But hands down, that debate is so much more important.
Is CPI very exciting?
Yes. When you think about Fed policy,
yeah, but isn't it done?
25?
Aren't we over that? Have we moved past?
Have we moved past?
It's really as long as we continue to show the progress. But we've been talking about this, and I think the fact is we're so towards the end of that getting inflation under control. So CPI is only going to matter if it suddenly spikes up, and we just cannot see from all of the other data on housing and all the other components that you're going to see a significant spike up.
Well, speaking of policy and marrying that with where we think the trajectory of interest rates are going, you still have 111 basis points worth of cuts priced in through the end of this year, let alone that September cut. I know that many traders are on edge between that 50 versus 25. With that much uncertainty and policy ahead and worries about fiscal impulse here with both presidential candidates, how can you be certain that you're going to get these rate cuts to materialize in any one-year time frame here?
I think you've got to separate two parts of this. The first is that 25 to 50 at the next meeting. I think that actually the market, you're exactly right, is pricing in around 35. So they're really just hitting it straight down that fairway. I think that 25 is more likely as long as that CPI print really kind of doesn't show any off trend coming down in inflation. We obviously had the jobs data last week. It was slightly weaker than expected, but we are still adding jobs. Going to the 111 basis points. So that's a big amount of cutting. And I think that, the risk here is that just keeps getting kicked down the road so that, the Fed kind of says, we'll do 25 now and let's wait and see. And I think that that's going to be what we do is kind of this stop start. If you were driving with your children in a car, it's like when they first start to drive and they kind of accelerate and stop. And I think that's what we see the Fed doing.
This show has a great analogy game, I've just got to say.
A lot of metaphors.
A lot of metaphors.
Yeah, but great ones. Although my kids are way too young to drive.
Don't put them behind the wheel.
But I do that. I do that sometimes. Okay, Katrina, you're going to stick with us. We have a lot more to talk about with you, including the big tech rulings, the EU, the ECB.
Luxury.
Yes, absolutely. We're going to get to all of those things. Coming up, Deutsche Bank names Tesla as a top pick, saying the tech company has the potential to reshape multiple industries. Hasn't it already done that? More in Top Calls next. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, JMP Securities says that Oracle is a buy, the firm raising its recommendation on the infrastructure software company to market outperform. Oracle, of course, reported earnings yesterday and sales that topped estimates for the quarter. And next up, Redburn Atlantic says that Costco is no longer a buy, downgrading the discount retailer to neutral. The firm says the company's risk-reward profile is looking less favorable. And finally, Deutsche Bank is naming Tesla as a top pick. The firm says that Tesla is, quote, in a league of its own and is poised to reshape multiple industries across auto, energy, mobility, and robotics. Sonali.
And we're back with Franklin Templeton Public Markets Senior Investment Strategist Katrina Dudley. And where we really left off here was this idea that it would be very difficult to achieve that 111 basis points worth of rate cuts this year alone, that you believe that it might be pushed out. So what would be the thing that holds this market up then? If we don't see those rate cuts materialize, is there a spillover risk to equities?
So look, what's the 111 pricing in? It's pricing in the bear case for the economy that we're going into a recession. And sometimes I think people just don't pay attention to the fact that, things are actually going okay.
That's what you keep saying.
I'm paying attention.
Okay, and this is great because okay is good. Yeah. I mean, we don't need euphoria. We're a big, large economy and things are going okay. Yes, there's always going to be pockets of weakness and we can spend an inordinate amount of time, but we need to be able to separate what is noise that is really an economic signal and what is just noise that relates to either bad strategy or something that a company is making a mistake in. And I think that we are of the camp that that the Fed has done their job and they have engineered a really good soft landing. And yes, there's always going to be a couple of bumps along the road, but that's okay.
So we don't need to cut to 3% or 2.5% terminal rate like we've been hearing from, Howard Marks and John Paulson.
No, I don't think we need to cut that to that extent. I think that we just need to do some level of adjustment because we probably tightened a little too much in response to the need to control inflation. The data's showing that we've actually controlled inflation. We still have some decent employment number. And so the need for the Fed is just an adjustment.
By the way, I just quickly, on Morgan Stanley this morning said that the euro's headed back down towards parity because the ECB is going to cut more aggressively. If that starts to happen at other central banks, does that pull the Fed in that direction as well? But
what the ECB, if they cut a lot more, it's in response to the European economy slowing more than expected. And I think that is, a recognition that the region doesn't maybe have some of the AI opportunities that they have. But some of the other areas where the European stock market is overexposed, we talked about, is the luxury sector. And that's got much more of a link into China. So, Europe as a region may be suffering because of things happening outside of their borders that are impacting, the greater European Union. Right. That drives the need to cut more.
Well, before we get to Europe and the luxury sector there, I want to go back to that optimism on the U.S. economy. And with that backdrop, I'm curious how you view a week like last week, where you had the S&P 500 down more than 4%, the NASDAQ 100 down nearly 6%. I mean, are those buyable dips when you couch that with your economic backdrop?
I think in this type of environment where we're talking about things just being a soft landing and muted and everything like that, any type of information can get exacerbated and the volatility is what is going to drive those movements. You combine that volatility because we're expecting a fairly benign environment with the political noise that we're hearing. And it's the political noise in terms of the U.S. election. We've had political noise, as we characterize it, coming out of the EU with the Apple and the Google court's decision. So I think that there's a lot of noise driving volatility, and that's how you explain a week like that. Like last week, it was volatility driven.
It's interesting when we think about the consumer. A lot of those troubles have been really contained to the lower to middle income consumers, but the luxury sector is a big question mark, partially because, as Matt makes a point, Ferrari, Lamborghini, record profits over there, but the slowdown in China is creating real issues for other luxury companies as well as U.S. consumer companies that are not luxury for that matter. Is there a story here that many investors might be missing on kind of the ripple effects that are going on across the globe?
I think one of the areas with luxury is it is, interestingly enough, almost have some characteristics of the hit movie business, because it depends on whether or not you have that hit influencer product. So you think about luxury, there's a stable part of luxury where you have the classics, and it's a fairly, it's aspirational purchase, fairly consistent type of purchasing. But then you have these hit products, and I think that we've had a couple of our luxury companies which have had some mistakes. They've had mistakes in terms of their product range, or they've had mistakes within the corporate suite, and that's been driving those things down. And then China is the incremental purchaser, and that the China consumer has been weak, and I think that that's the other knock-on effect. So there's just a lot going on in this sector, so it's hard to kind of bucket it all into one category.
But you need Chinese consumers to buy handbags. Doesn't really matter if they're buying 12-cylinder motors.
In terms of buying the 12-cylinder motors, they need to be able to drive them somewhere on the Chinese roads. So I think that it is a little more difficult. The Ferrari purchase and the Ferrari, I think most of the Ferraris are sold to the existing customer base of Ferrari.
True.
So you're just looking at who is my incremental next customer. In the handbag market, you need a lot more refreshing of that customer base, because I think you see a lot more cycling.
All right, very cool. We could talk about handbags forever, couldn't we?
Probably.
Katrina, please come back very soon. Franklin Templeton Public Markets Senior Investment Strategist Katrina Dudley. I want to take a quick check at U.S. steel shares. Big drop in the early trade today, down more than 5%. Of course, we've been talking a lot about the fact that both parties want to block the Nippon Steel. The Biden administration has actually taken action to do that, the Nippon Steel purchase of X, and they don't seem to have any white knight out there.
What's absolutely fascinating, too, is you have S&P Global coming out and saying Nippon Steel might be very pressured here with this uncertainty that's dragging out over an extended period of time.
A day after JP Morgan upgraded it to an overweight, though, so a little sell-side action there.
Upgraded X, upgraded U.S. Steel.
That's
because
classic.
Nippon Steel obviously is pressured. You've got the current White House and possibly the incoming administration both against this takeover. I don't think you can get much more pressure than that. Coming up, Apollo is breaking ground on a new private credit ETF. We're going to talk about that in today's Wall Street Beat. This is Bloomberg.
Time now for the Wall Street Beat. The moment has come. Apollo is working on its first ETF, teaming up with State Street on an offering that will include private credit investments. Eric Balchunas, senior ETF analyst at Bloomberg Intelligence, is with us now. Of course, they need regulatory approval. About 80% of the fund will be investment-grade credit. 20% is allowed to be in high yield. And of course, the SEC has those rules. 15% of the fund can only be illiquid. So how do they navigate this? Is this surprising to you at all?
It's not surprising that they're sitting out there in labs everywhere trying to figure out how to ETFize private credit and private equity. It's a, $10, $12 trillion market, depending on how you look at it. And there's less companies going public. So the investors out there definitely want access. So whoever can bridge that gap is going to make out. And so there's incentive to do it. We saw what happened with Bitcoin. They figured that out. And boom, you saw the success there. So same deal here. It's a race for the prize. Now, the way they're going to do it is interesting. How do you figure this out? Because ETFs need liquidity to function. The underlying has to have some liquidity. Private credit, not liquid. So apparently Apollo is going to provide a backstop to the private credit portion and has contractually agreed to provide intraday executable firm bids on all of those investments held by the fund. So in other words, they're going to backstop it. And if they can make the private credit portion liquid and the public bonds are already liquid, you're in business.
Right. So, Eric, we have less than a minute left here, but how do you think the SEC is going to read this? With any first-of-its-kind ETF, there's always the question whether the SEC will give its blessing. What's your feeling here?
I think it's okay. I mean, they've blessed senior loan ETFs, and like those don't trade, they barely trade. So there's been illiquid things put in ETFs. This almost seems more liquid than that. So I think they'll be okay. This is a baby step to where they probably eventually want to go. So I think they'll approve it. Plus, it's State Street, big name. They've worked with the SEC. But maybe they'll punt, like in Bitcoin, it'll take 2 rounds. I don't know. My guess is this is fine.
One baby step for the ETF world, one giant step For those in private credit, Eric Balchunas of Bloomberg Intelligence, we thank you so very much for your analysis. Don't forget, you can watch Eric and Katie on ETF IQ every Monday at 12 p.m. Eastern. And don't miss tomorrow's Wall Street Beat, because I'm speaking live with Cantor Fitzgerald CEO Howard Lutnick at the company's headquarters here in New York City. That's at 9:45 a.m. Eastern. This is Bloomberg.
Minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
Coming up, a big win for the banks. U.S. regulators scale back capital requirements for Wall Street firms from 19% to 9%.
And it's David versus Goliath. Allspring CEO Joe Sullivan is on a mission to attract more business in a fiercely competitive asset management industry.
Plus, Philly face-off. Harris and Trump gear up for their first and maybe only debate. We're live on the ground tonight with the latest. Let's get a check on these markets right now. You can see we do have a rally on our hands, not a huge one, especially by yesterday's standards, but still green nonetheless on the S&P 500, currently up about 0.3%. You look at the NASDAQ 100, up about 0.4%. Not huge numbers, but still a relief after what we saw last week. And then the bond market totally quiet when you take a look out the curve. The 10-year Treasury yield currently, I'm going to call that flat on the day, Matt.
Let's take a deeper dive into markets. We're joined by Nancy Daoud, Ameriprise Financial Private Wealth Advisor and the CEO of Opus Advice First. Nancy, I wonder, first off, your thoughts on the political risk that we're facing here. Obviously, we had a growth scare the first week of trading in September, and it was a big drop. We've bounced back a little bit from that, but I think because the debate is tonight, we'd love to hear your thoughts on how the election affects markets.
Well, the election is always a very volatile time, especially the current time that we're in, the 60 days prior to election day. So we're going to see a great deal of volatility, but that's also not unusual for September and October. I always wake up the next day after Labor Day and it's like, I feel like, oh, just wake me up when September ends, but that's not unusual. But we tend to forget also that following September, October, usually a very strong year end. So this is a great time to maybe consolidate, rebalance, or deploy some cash or dollar cost average in. Make that volatility work to your advantage.
And Nancy, I want to acknowledge also that as we speak right now, you have Michael Barr, the Vice Chairman of Regulation, or Supervision rather, at the Federal Reserve, speaking at the Brookings Institution, really setting new groundwork for what bank capital rules will look like. This was a point of anxiety all year for the financial markets, for banks in particular. When you see them looking to roughly cut in half that initial proposal for capital rules, does it set off a wave of fresh investment in the banking system, knowing where we could have been otherwise?
That's very possible. There's not really enough information to make that determination or to predict anything. I think the focus now is really on monetary policy, what the Fed's going to do, and whether it will stick or not. And then also the outcome of the election. Then we'll see what's going to turn out and what won't turn out.
And Nancy, let's bring this conversation into your portfolio, where you're finding the opportunities and attractiveness right now. Because I'm looking through your notes, I see that you're still feeling pretty good about tech, which is interesting in light of the last couple weeks. Obviously, tech took a big beating last week. Talk us through why you still see the bull case there.
Clearly because of time frame. There's going to be significant swings up and down. And one should recognize that about the tech sector. But ultimately, it is likely to be up because of the AI boom and all of the innovation that's going on. So long term is the key. And when I say long term, the definition of that is 7 to 10 years or longer. It's not 1 week or 2. So that's the key there. And then also, if you're going to be heavily weighted in technology stocks, then make sure that there's some buffers in place so that you don't feel like you're on a big roller coaster ride up and down.
Yeah, I mean, we were talking with Bill Smead of Smead Capital earlier, Nancy, and he was calling this one of the 4 great peaks in the equity market, comparing it to 1999, comparing NVIDIA to Cisco. We've seen, obviously, incredible run-ups in these mega-cap tech stocks. How do you hedge against the potential of a burst?
Well, you really can't unless you have a broader, more diversified portfolio and short-term needs are kept in cash. That's the only way to make sure that you don't go up and down like a roller coaster ride. But diversification certainly helps. You know, you don't want to be completely in technology only. Other sectors like financials and healthcare and certainly energy is something to watch these days with all the geopolitical risk. And then some buffers, you know, place some fixed income in there to buffer the portfolio so that you have some stability, especially in weeks like last week. You know, defensive stocks did very well last week.
Speaking more to that diversification, Nancy, do you find diversification largely through other areas of the equity markets, or do you look to other instruments, fixed income, cash, gold, or otherwise?
Yes, fixed income is certainly a part of that for diversification, and then also some structured notes, you know, to hedge against to buffer the downside, tied to the S&P. But that's mainly how we diversify, and it really has to do with the risk appetite of each investor. It's not a one-size-fits-all situation.
And not a one-size-fits-all situation. I'm curious what would upset your base case right now, because of course we're through earnings season. Of course, we have a pretty good idea of what the Fed is going to do. We do have some big unknowns out there when it comes to politics, for example, namely the debate tonight. But what are the big risks that you're keeping an eye on right now?
Well, the job report could be, it's certainly showing some weakness, and it could be a lot, that could go down much faster than we all think. That's a possibility, but probably the biggest black swan event that could happen that we would be really not prepared for, or there's nothing anyone can do about is the geopolitical risk, is war, the risk of war.
But inflation, not a concern for you. We are getting the CPI out tomorrow, and some people are very excited about it.
Yes, it looks like it's going to come out very close to what the Fed projected. And so that certainly makes an argument for them to cut some rates. And we expect rates to be cut at least 25 basis points. And there's a lot of noise about whether it's going to be 25 or 50. It really doesn't matter. The most important thing is that we stay on a trend as opposed to up and down. So we really hope that continues. That's the focus, where we should be there. But the risk of inflation really has to do with the money supply. It's not so much the interest rates. If the money supply is going to grow again, then we're going to have inflation again. So these are the things. It's a very, very difficult balance that the Fed has to maintain, and that's what we're watching.
Nancy, we thank you so much. Of course, that is Nancy Daoud of Ameriprise Financial. I want to bring you back to that breaking news. Of course, it is a landmark moment again for bank regulation, but it matters because it ultimately comes down to how much capital is going to be floating throughout the economy. And of course, we know that the Federal Reserve, the Vice Chair of Supervision, Michael Barr, is speaking to the Brookings Institution, rolling back these rules. It will take a while to implement, of course.
Rolling back proposed rules.
Proposed rules.
Not
correct.
Actual rules.
Correct. Yeah. Those proposals never saw the light of day. And of course, we're hotly contested.
And you think about the timeline here. So we're expected to get the complete revisions. According to Bloomberg reporting, that could run up to 450 pages. Chanel, I know you're going to read every single one. Those could come as soon as September 19th. And then we know that Jerome Powell has said the comment period could be up to 60 days. So there's still a lot of wood to chop.
There's wood to chop. The interesting thing here is compounded against the macro backdrop for a minute here, because we've had really loan losses starting to rise, charge-offs starting to rise under the system as well. Not to alarming levels by any means. They're kind of normalizing, but we'll see where things go. Are they rolling back these rules at a time where the economy is starting to weaken more materially?
But don't the banks put aside loan loss provisions that are separate from these capital buffers?
They do. They do. So they're increasing the capital buffers. And so the rules becoming more strict at a time where you can presume lending already tightening to some standard.
Yeah, to me, 9% seems like a lot. I mean, they already have fairly large capital buffers.
But even still, can we call this a win for the lobbyists? Do you think about that fierce opposition getting 19% down to 9%? The lobbyists did their job.
You know, the lobbyists on Wall Street have been fascinating this year, because you think about the pushback they've had with the Fed, with the SEC, major lawsuits against the SEC for new rules and regulations. You saw really the Biden administration regulators go hard, and Wall Street pushed back. You ended up somewhere in the middle.
Think about Elizabeth Warren versus Powell on Capitol Hill.
Think about that.
That was rough. I think it'll be interesting in that this is kind of wonky, right? I mean, it's unlikely to be something that Kamala Harris and President Trump talk about tonight.
Never know. You never know.
It's
they
true.
might be studying up right now.
But, you know, she will want her fair share from corporations. More about the corporations. Interestingly enough, to your point on these are still high requirements, you do have the KBW Bank Index down 1.6% today, while the broader market is getting a lift.
I wonder if they expected a complete reversal of, capital requirement increases.
You end up somewhere in the middle. Anyways, let's get a look at stocks moving this hour. There's a lot more going on. Here's Abigail Doolittle. Abby.
Let's start off with the shares of Oracle, because we do have the stock. Oracle up about 12% right now, heading to its best day since December of 2021. They put up a great quarter, record profit and booking. Sales up 7%, and the AI products, the demand there really boosting Oracle and their business. NVIDIA trying to make a 2-day win streak. That would be the first in almost a month. Right now up 1% yesterday. A very solid day as well. Not a lot of news there. Investors really waiting to see how that whole range, that battle between the bulls and the bears shakes out. Where we know the bulls are definitely winning. Let's take a look at the shares of Mission Produce. Right now up a very healthy 21%. And this, of course, after the avocado supplier posted, I should say, what one analyst is calling a blowout quarter. They modestly increased the forward outlook. Nonetheless, the stock really having a pretty good day, as you can see, and up about this much on the year as well. Turning back to big tech, if we take a look at Apple and Alphabet, a bit of a mixed picture here. So Apple down about 0.8%. And of course, they did lose their tax fight. They are going to now have to pay $14.4 billion, or that could be the amount that they pay. That is the Irish tax bill fight that they did lose. Alphabet, it's interesting, up about 1%. They received a penalty for abusing their market dominance, their market power. It was upheld. So this is a double boost for the EU's crackdown on big tech. But it's interesting to see the two different reactions between these stocks. Probably, Matt, because Apple, that's much more related to the numbers.
Right. I mean, setting aside $10 billion would be difficult for most companies, even in the S&P 500. But for Apple, it's pretty easy to do. And I'm not going to say it's a rounding error, but let's just say they have over $153 billion in cash and marketable securities. Abigail Doolittle, thanks very much for that. Coming up, the trading unit at Goldman Sachs is on track to drop 10%. We'll tell you what's behind the weakness this year. This is Bloomberg.
Some breaking news right now when it comes to the oil market, and that is Brent oil falling below $70 a barrel for the first time since December 2021. We know that there's been a lot of oversupply fears. You can see that clearly if you take a look at the global benchmark. Of course, we've got downbeat economic data from China and the U.S. as well, really stirring fears here. You can see that in the price right now, currently down about almost 3%, Matt, and below $70 a barrel. We'll continue to keep an eye on that.
Yeah, that's a huge move. All right, let's get to high interest now. A look at what's making headlines around the world. Israel attacked what it said was a Hamas base embedded in a humanitarian area containing a Gazan camp for displaced Palestinians. killing 19 people, according to the Hamas-run health ministry. The incident is likely to stoke international concern for civilians caught up in the war, which has lasted now almost a year. The U.S. continues to oversee efforts to secure a ceasefire, but it doesn't look like there's a lot of progress being made there. Bridgewater is close to a deal to lease office space in Manhattan, far from its headquarters in Westport, Connecticut. The move marks a big departure for the hedge fund from its founder, Ray Dalio, who said the company's headquarters helped Bridgewater nurture its unusual culture. And Goldman Sachs, their trading unit, is on track to drop 10% from the prior year, led by a decline in the fixed income business, according to CEO David Sullivan. He also disclosed at a Barclays conference that the bank will take a $400 million pre-tax hit in its narrowing consumer business as it moves away from its credit card tie-up with General Motors. That, for Goldman Sachs, is a rounding error.
And for more on Goldman Sachs, we are joined by Bloomberg senior banks reporter Sridhar Natarajan, and you've covered the ups and downs of the last couple of years. David Sullivan says this 10% decline is really off of high levels last year. But at the end of the day, one thing that fascinates me is pay. Compensation is going to be predicated on all this. A couple of years ago, that money pool was being spread among consumer bankers and traders. Traders had a good year. Now you have not as much of a consumer footprint, but the traders are not having as good of a year. What are the dynamics playing out
So
here?
let's just take a slight step back. Before heading into this week, the stock was up 27%. The Goldman stock had reached $500 per share, which was an all-time high for them. So they've had a pretty good year. So when you think about what the CEO did yesterday, I think he was seeding the ground just to lower expectations going into the third quarter results, and he laid out 2 or 3 different line items. Having said that, trading is down, but 2023 was also another very strong year for Goldman traders. So I don't think they're that nervous and worried about their comp pool for this year. But yes, it may not be as good as last year for sure.
So tough comps is basically what we're saying here. I also want to talk about deal making because, of course, David Sullivan had some words about the environment when it comes to the FTC, which we know has been very aggressive.
Yes, he did say investment banking is picking up, but even there, he peppered in a few notes of caution. He said some of the headwinds are tied to what's happening at the FTC, their strong antitrust posture and all the pressure on Lina Khan and all the concern and discussion around Lina Khan has been out in the open for quite a while. He also said financial sponsors activity, this is the big private equity firms, the buyout firms, they haven't been as active as he thought they might be. Strategics is one area where they have seen a lot of activity. What was interesting to me was he listed out weakness in the trading business, in asset and wealth management, part of their retail retreat, did not provide any guidance on investment banking. And Mike Mayo was out with a note this morning saying perhaps he's holding back the good news for the actual results.
I feel like, Goldman Sachs gets a lot of criticism, but the stock has outperformed every other bank on the street. I mean, if you look at a 5-year period, which is my default because I always use the comp function on the Bloomberg, up 117%, better than JP Morgan, better than Bank of America, better than Wells Fargo, better than, yes?
On our league tables on Bloomberg, they have 25%, a fourth of the M&A market share out there. That's a bigger lead than what I've seen typically, right? You have JP Morgan at 22%.
Yeah. So, I mean, we talk about the consumer business as a whiff, right? And we talk about today the $400 million write-down, but they're doing very well, it seems, under David Sullivan's leadership.
And that's the important point. You have to strip out some of the noise around the criticism because Goldman Sachs does attract a lot of attention. But if you actually focus on the core criticism, a lot of it was into their foray into the consumer banking business. Like Sonali points out, they have a dominant position in investment banking. Goldman Sachs leading the merger advisory business is, at least over the last 2 decades, similar to the sun rising from the east. That's not a surprise, and they've managed to hold on to that. Now that they have carried out this retail retreat, or at least are well into that process, and they're focused on their core business, the last few years have been particularly strong for that. Investment banking has been picking up again, and trading has been really strong. Goldman's really good on those fronts, and that's why the stock is performing so well.
What's fascinating to me about the trading kind of weakness here relative to the gangbusters last year, I understand these markets have been extraordinarily volatile. Why is it that trading isn't showing up in a bigger way?
It's all that we're talking about here is relative to expectations. Analysts were already talking about a 6 to 7% downturn. When I say downturn, I just mean 6 to 7% down compared to what it was in 2023. Solomon came out and said down 10%. That's the one thing that analysts struggle to factor in heading into the result. You already know, you have a good sense of what deal making is going to be like. As their asset and wealth management business move towards more of a management fee model, you can model that in. So the big unknown often does end up being what's going to happen with trading. And so when the CEO comes out and gives you some sort of a guidance, that's a good indicator for the stock to move off that. And perhaps one of the reasons why the stock is down 4% today, one of the worst performers on the index for the day, not for the year and not for the last few years, where undoubtedly Goldman has done really well, man.
All right, Sri, before we let you go, we have to talk about the other big banks news of the day. Of course, that is that bank capital rules proposal. Apparently, the boost is going to be cut basically in half from 19% to 9%. And Matt keeps pointing out that 9% is still a big number. Is Jamie Dimon happy?
If a bank CEO is happy, they're not doing their job. Their job is to go out there and say they're not happy. You're not a good negotiator if you're going to say, thank you very much, this was great. And this was telegraphed by David Solomon yesterday. There was expectation that these capital rules will be changed to the ballpark of where we're seeing them land. But David Solomon did say we'll have to look at the very specifics in this, how they're actually dealing with the operational risk, the market's risk. And there is a comment period. That comment period is likely to be extended. Banks in the U.S. at least are certain that this was not the goal of the capital rules. The Basel III endgame was to standardize European banks to the U.S. levels and international banks.
We don't have a lot of time left. I want you to comment on this quickly here. The trading rules within this, how onerous could they be?
It won't be as bad as we thought, but some of the initial concerns were around some of the calculations tied to it. Within prime brokerage, we were told that you were double calculating the risk involved. They said it didn't make any sense. It's, of course, the industry talking, and that's how they're going to express their concerns. But we still will have to wait for the specifics to see how they have tweaked them before we can be sure whether the banks are happy or not.
All right, Sri, got to leave it there. Always a pleasure to talk to you. That, of course, is Sri Natarajan. He is our senior banks reporter over at Bloomberg News. Let's take a quick look at the markets right now. You do have a rally on your hands, even with bank stocks lower, of course. The S&P 500 actually giving back its gains, now down about 0.1%. The NASDAQ 100 trying to hold tough. Small caps in a world of hurt. This is Bloomberg.
In a market of Goliaths, Allspring Global Investments is a David. Since spinning off from Wells Fargo 3 years ago, the asset management firm competes with the deep pockets of BlackRock and State Street and does so with $571 billion in assets under management. Allspring's CEO, Joe Sullivan, has run the company since the rebrand, and he joins us now to talk about how you do it. Joe, great having you on set. Thanks so much for joining us. We love to talk to CEOs at this time in the program and just, get best practices and strategy. I mean, you have a monumental task, but you're making great strides. What do you think the biggest keys are in this business?
Look, first of all, you mentioned David and Goliath. If I recall properly, David won.
Yes. We're giving you the benefit of the doubt.
Thank you. I think it's, scale is important in the business for sure. I think on top of that, though, it's what you actually do. And we think of ourselves as being scaled enough, big enough to matter, but also small enough to be nimble and to change. And that's part of the beauty of Allspring. Coming out as Allspring, we were a big enough size where we can compete for business, but we're small enough to be able to be nimble and change. And we saw the deal with GTCR and Reverence Capital as a catalyst to change our model and evolve our model over time.
Where do you see yourself in the consolidation story? Because ultimately, it's really interesting to see mid-sized managers, really large managers. BlackRock alone did 2 acquisitions this year alone. Do you see yourselves playing in that consolidation story, maybe rolling up more managers or merging with another one?
I think we would, I think in terms of M&A and the acquisition game, we would look to add capabilities that are accretive to us. So we've got plenty, we're very strong in the large categories, equities, fixed income. We don't have a lot in alternatives, private markets. So I think over time you could see us do that. Certain select categories in more traditional areas like emerging markets, emerging market debt in particular, you could see us do something there potentially as an acquirer. Obviously, as being owned by private equity, at some point in time, there's another transaction in our future. Could we be on the other side of that for someone who wants to gain a scaled manager? That's a possibility, but that's not what we focus on. We just continue to focus every day on building Allspring into being a winner in the business going forward.
And let's talk about something you're focusing on, and that's ETFs, which I find really interesting. I know that you told CityWire in 2023 that the ship has probably sailed on ETFs. You couldn't see any logic to get into that space. I know that you've since filed for ETFs. So walk us through that sort of mindset shift, because I do find it really interesting when leaders such as yourself do change their tune.
So, you know, candidly, either I misspoke or they misunderstood me at CityWire, and I love the folks at CityWire, but what I was referring to is the ship has sailed as it relates to passive ETFs. We were not, and we will not get into the passive ETF market.
No new SPY.
Pardon me?
No new SPY.
No new SPY. So, but as it relates to active ETFs, we were a little bit in wait and see mode. And I think what we've seen over the last 12 to 18 months is that the investor has spoken. They've clearly adopted active ETFs, been an explosive growth of active ETFs over that period of time. We do, as Allspring, want to be vehicle agnostic to our clients. We want to bring our strategies. We don't really want to care, and we don't care how they consume them, whether it be in a separately managed account, whether it be in a mutual fund, whether it be in a CIT, whether it be in an active ETF. So as we watch this unfold, it became clear to us that this is a vehicle of choice by the client, by the investor, and we're going to participate in that.
And this is a bit inside baseball, but it's interesting and important when it comes to exemptive relief for multi-share classes, basically asking the SEC to be able to launch an ETF share class of an existing mutual fund. You're one of 20-something asset managers who have asked the SEC for that. What's the logic there versus just either converting a mutual fund into an ETF, which has been done, or just launching organically?
It's really around the tax treatment and being able to move out of a mutual fund and into an ETF in a tax beneficial way. And I think ultimately that's one of the main drivers and one of the main attractions of active ETFs is the tax benefit nature of it as opposed to the mutual fund. So I think this would tend to make your ability to convert from a mutual fund to an active ETF without necessarily realizing the same kind of tax consequences, capital gains, and things like that.
Well, it'd be really fascinating to see what the SEC does with that, since they're starting to pile up, of course, those asks.
Because it makes sense,
yes.
And it's good for the ultimate investor. That's the real beneficiary of this, is the ultimate investor. The Treasury might not be the benefit of it, the IRS, but it's the right thing for the client.
Right, the direction of travel.
You don't want them
there.
trapped. You don't want the investor trapped because of capital gains. If they want to make a change in their investment strategy and they want to move to a different strategy and it's appropriate to do so, they shouldn't just be constrained by virtue of having to pay a capital gains.
Well, I could keep going on this, but I do also want to talk about private markets. I'm going to quote you from CityWire again, so I hope this one is right.
I hope it's a good one.
Of course, you said that you're not in a rush to add private market capabilities. You think about private assets right now, extremely hot, of course, issuers trying to make them available in the ETF wrapper as well. How do you think about private markets and potentially entering that space?
I think long term, we will think about adding private markets that are an adjacency to what we do. So how I think about that is, we're $570 billion in assets under management. We're over $400 billion as a fixed income manager, if you include everything from liquidity out to long credit and everything in between. So we're a major player in fixed income. I can see us down the road adding an adjacency like private debt, private credit, potentially infrastructure debt, real estate debt, things like that that play on our ability to assess credit worthiness and credit broadly.
Joe,
so I could see that.
It's no secret that there are hordes of private credit managers right now looking for a sale.
Right.
How many are you talking to? I mean, how many are knocking at your door saying, hey, maybe you're a good home for us?
We have talked to some, and when I say we're not in a hurry, part of the reason for that is having come out of Wells Fargo Asset Management into Allspring, we have so much opportunity in the public markets, both in equities and in fixed income. There's plenty of activity, plenty of money in motion in both of those markets. We want to make sure that we capture the share that we think is appropriate, where we've earned the right to win. We want to make sure we're firing on all cylinders there, and then add more capabilities that we can leverage the relationships we have with clients to distribute.
You know, I covered for years banks and wealth managers in Germany, a lot of whom faltered because of out-of-date technology platforms. How important is that? And when you bring in AI, do you do that in-house or do you outsource that kind of?
I think well, first of all, I agree with you on technology platforms. And one of the most significant events for Allspring since we emerged as Allspring over the last 2.5 years is we exited a transition services agreement with Wells Fargo. We had been basically completely extricated from Wells Fargo with the exception of riding on their infrastructure. We've now completed that as of the end of July. We're completely out. We are completely cloud native, which I think gives us a lot of flexibility and agility as it relates to our infrastructure and our technology platform in a way that being on-prem or being a hybrid between on-prem and cloud native allows. So we think this is a competitive advantage. We've been able to attract a lot of strong engineers and technicians who want to join a firm of our size that is entirely cloud native. So we feel good about that. As it relates to AI, we're going to use AI as a tool, and whether we do that internally or whether we do that, outsource that, we're going to leverage that in conjunction with what we do as a tool to support our clients.
I grew up listening to Margie Patel with like Abby Joseph Cohen
Sure.
and Barton Biggs
Sure.
and like just among the giants of Wall Street.
She is.
How important is that star power to you?
I think that the business has evolved away from star managers, and one of the things I feel, and that's nothing against Margie or any of our other managers. We've got some very, very good high-profile managers, but what's important is that our investment managers are really increasingly teams of professionals that work as an investment team, and I think that's important from a succession and continuation standpoint, and I think the industry has just kind of moved away from that star power kind of model.
It's a much bigger business. It's just that I'm a little bit starstruck. Still, whenever I talk to her. And you, Joe, thank you so much for joining us. Really appreciate you stopping by.
My pleasure.
Joe
Thank
Sullivan
you.
there, the CEO of Allspring. I want to quickly break some news on Volkswagen. This company last week made plans to possibly close factories in Germany for the first time, which was already a huge shift and a bad signal for one of the biggest economies in the world, the biggest in Europe. Now they're going to end job protections that were supposed to be in place until 2029. So they continue to make announcements aimed at cutting costs because of the difficulties that they face in terms of inflation and in terms of competition from China, especially for the namesake brand of Volkswagen. Remember, they have 12 or 13 different automotive brands. It's been a real problem for this company, and they have struggled ever since, really, the Dieselgate scandal of 2015. Let's get a check on the markets right now. For that, we go over to Bloomberg's Abigail Doolittle. Abby?
Well, investors are really trying to decide which way they want the S&P 500 to go. This is a 7-day chart, so including lots of last week or all of last week's trading. And over this time period, down more than 2%. But today, up ever so slightly right now. So it's going to be interesting to see whether or not this near-term downtrend can be broken. Now, beneath the surface, there is a real tug of war, a real battle between those bulls and bears. Up top, Campbell's Soup up 1.2%. They filed an 8K. They are changing their name to the Campbell's Company. They also talked about seeing organic sales growth of 3 to 4% over the next 3 years. They see an operating margin reaching 17% in fiscal 2027. Overall, investors are positive to this news. Microsoft up a very healthy 2.2%. Seems to be in sympathy with that strong Oracle quarter, that AI demand, investors translating that over to Microsoft's business. JP Morgan, on the other hand, down 5%. This, of course, is Daniel Pinto of the company is out there saying that analysts, investors being too optimistic about the company's net interest income figure for next year. $89.5 billion is what the street is looking at. He's saying that's, quote unquote, not very reasonable at all. It will be lower. Investors clearly sending those shares lower. Ally Financial, the worst day since 2020, down 15%. The company that really does financing for cars. At a Barclays presentation, they said that auto delinquencies are up. There's also weaker credit trends. We're seeing this somewhere else too, Sonali, with credit trends overall, credit card delinquencies. If we go into the Bloomberg terminal, we will see that these delinquencies overall are higher. So this chart goes back to 2016, and we're looking at different age groups transcripts here. We can see, though, 2023, 2024 for all age groups going higher. And in white there, that is 18 to 29 serious credit card delinquencies at 10.5%. So this chart really confirms what Ally Financial said at that Barclays conference, even though this is credit cards and that's car financing. But the credit sphere looks like it's weakening right now.
This is what I've been saying, Abby. It's fascinating. You have JP Morgan's president saying analysts are too optimistic. And you have to wonder, Matt, if
I will say that I
being
think
optimistic elsewhere.
I was talking about this with a wealth manager yesterday. It's better to make a mistake like a credit card delinquency between 18 and 29. Then you learn from it. And I got into bad credit card debt in college, and I haven't really used one since.
And how's your credit score now?
Very good.
There we go.
Fun fact, some of these
30 years
capital
later.
rules can make it much harder to pay late. But we will talk about that another day. Bloomberg's Abigail Doolittle, we thank you so very much. And coming up, it's debate day in the United States. We're going to take you live to Philadelphia, where preparations are underway for the face-off. Stick with us for that conversation. Up next, this is Bloomberg.
All right, we're just 8 weeks away from the presidential election, and of course, hours away from the debate when former President Donald Trump and Vice President Kamala Harris are gearing up for their first debate in Philadelphia. The stakes are high, of course. Let's go to Bloomberg's David Gura, who joins us on the ground in Philly. And David, talk us through the terms of engagement as set out by ABC, because no live audience, mics muted.
Yeah, so I'm in the convention center a few blocks away from the National Constitution Center where this debate is going to take place. And the feel will be very similar to what we saw in Atlanta. They will be in there, the two candidates, with the moderators, and the press in its many hundreds will be here in this spin room behind me, kind of watching it all unfold. So there won't be an audience, there won't be journalists in the room while that debate is taking place. And you're right, the mics will be muted in the same way that they were back in that debate in June. While one candidate is speaking, the other candidate's mic is muted, and we'll see what effect that has on the way these candidates interact with one another. Of course, one could jump in or say something or respond. We just would be unable to hear it, and that could create a weird moment in and of itself. Each candidate will have 2 minutes to respond to each question. Then there's a minute for rebuttal, and the moderator has discretion to sort of give more time to one or the other after that. So they've said, David Muir and Lindsay Davis from ABC News, who are moderating this debate, their job isn't to fact check, which is something that we heard almost verbatim from CNN before that debate in Atlanta. They're not doing it in real time. Their job is to ask questions, they say, and to give these candidates an opportunity to speak and present themselves to the American public.
Yeah, I was going to ask, because to me, one of the biggest disappointments in the last debate, aside from, the performance of the candidates, was the inability of the moderators to fact check, just to let someone lie and have it just be out there. Why wouldn't they want to fact check, at least to some extent, any sort of bold-faced lies?
I think you're not unique in your disappointment, and as you've probably observed over these last few weeks leading up to this debate, there's been a lot of argument about what the rules are supposed to be. So I went through all of them, but even that small rule about muting the microphones was something that was really hard fought by both of these campaigns. I think that these moderators understand the very difficult position that they're in. Of course, at ABC News, like at CNN, there's been a lot of work that's gone into this debate, a lot of studying on all these policy points and what the questions are going to be. But I think that there is if I may say so, kind of trepidation about how much they should jump in, what that fact checking would look like. I don't want to call it an impossible job, but I think that they acknowledge it's a difficult job. And again, fundamentally, it comes down to what these two campaigns agreed to, and a tenet of that is that there isn't going to be kind of real-time interjection or a lot of real-time interjection by these moderators.
At the end of the day, what are each of these candidates here to accomplish, David? Because we have heard really both sides make plenty of remarks about the other. They could sit there all night and defend themselves. But do you expect them to sit there and put a foot forward and really speak about policy? How are they going to show who they are to the American people?
I do not expect a lot of nuance about policy, and they could prove me wrong. And if they do, great. That gives us a lot more to talk about and Americans a lot more to think about and discuss after this debate. But I think both candidates are looking for viral moments, maybe on policy points that will carry past the hour and a half this debate is going to last tonight. But let me take both candidates in kind, starting with Vice President Harris. She's looking at these latest poll results and seeing that there is still a large part of this electorate that doesn't know who she is or what she stands for or what she hopes to do policy-wise. This is a huge moment for her to try to rectify that. This may be the only debate between these two candidates during this cycle. For President Trump, former President Trump, it's an opportunity to sort of double down on what we've heard on the campaign trail. That is, he is really trying to tie her to President Biden and what this administration has accomplished and not accomplished as he sees it. There's been a very studious effort on the vice president's part to kind of chart a new path, suggest that she would do things differently. The Trump campaign is adamant that this would be more of the same if she's elected president in November. So I think we're going to see a lot of that from former President Trump tonight, this insistence that it would be more of the same were she to be elected in November.
And David, I'd love to hear your thoughts on how this debate might play into the polls. We know this has been a very abbreviated presidential campaign when it comes to the Harris camp. Of course, a lot being compressed into just a couple months here. And right now, I mean, heading in to tonight's debate, the polls are very, very close to even. Usually, I mean, you have several debates, so one necessarily doesn't matter as much as maybe this one does tonight.
Yeah, customarily over a long campaign, you would look for a bounce after the convention. You didn't have that for Vice President Harris because she'd just been in the race for a couple of weeks at that point. We did see her numbers really spike from the get-go through that campaign. I mentioned that most recent poll by the New York Times and Siena College. It shows that perhaps her campaign is stalling when it comes to enthusiasm and interest, and I think that's what her campaign certainly is really looking at here, trying to, yes, assess or hopefully change the fact that that's the case on her part. And President Trump, I think both of them acknowledge the fact that this is an incredibly close race, as you say, Katie, well within the margin of error, both at the national level and in these swing states as well. So I think it's fair to say neither campaign is taking anything for granted here. We hear from the former president a distrust or an adamance that those polls are wrong. You look at the memos that you get from the Harris campaign, there is an insistence that they see themselves as underdogs here. They're not taking anything for granted. And I think that the travel schedule that we have seen from both of these candidates really emphasizes that. You know, at the end of this week, Vice President Harris is going to North Carolina, which is seen as a swing state, and back here to Pennsylvania. Donald Trump is headed to Arizona and to California to host another press conference and do a fundraiser out there as well. Right. So they're traveling a ton. We're seeing a lot of specific states, places they go back to over and over again. I suspect that's going to continue at an even more accelerated pace going into the election.
David, we're looking forward to your readout. That is David Gura. Thank you so much. Bloomberg Television and Radio will have special coverage of ABC's presidential debate between Harris and Trump tonight, starting at 8 p.m. Eastern. Katie.
All right, let's get a check on these markets right now. Of course, you can see the S&P 500 back to flat on the day. We had been higher. Of course, we had a lot of happy feelings yesterday, not necessarily right now, losing that momentum when it comes to the big benchmark. Big tech trying to hold on here. Of course, the NASDAQ 100 up about 0.1%. We'll watch that closely. The bond market, a little bit of a rally, down about 2 basis points. Let's get to some of the bank moves, though, because an interesting move when it comes to the big banks, of course. And in the last hour or so, you had JP Morgan Chase and co-president Daniel Pinto saying that analysts are being too optimistic in projecting next year's expenses and net interest income. You can see that reflected in shares currently down about 4% over the past 2 days.
JP Morgan is having its worst day since April 12th, if you could believe it, on the heels of these comments. You have every bank, Katie, except one firm in the KBW Bank Index down on the day, really dragging down the index. You have Capital One and Goldman really following those doldrums. Let's see how the trade plays out, guys.
Yeah, don't forget big tech. You have Apple down. It's only a 1% drop.
Wow.
But for a $3.4 trillion
It matters. JP Morgan down.
It does. Yeah, no, the banks are, I think, the big story for sure. Looking at the losing side of the ledger on the S&P 500, they're all off. Banks and financials alike. This is Bloomberg.
Coming up on Open Interest tomorrow, don't miss our interview with Cantor Fitzgerald CEO Howard Lutnick. We are live at the company's headquarters here in New York City. That's at 9:45 a.m. Eastern. And here on set, a big conversation around that CPI print. Stick with us through the week and through the close. This is Bloomberg.